Okay, the first thing that everybody needs to understand is that the consumer price index is not inflation, is a measure of inflation. The CPI index was created by an economist called Irvin Fisher that went bankrupt 3 times in his life because the stock market crashed on headlines of bread is up 50% and things like that. No? So what happens then, he said, okay, let's put bread with hotels. Hotels not going up, bread going up 50%. Inflation, CPI, is only up 2%. Okay. And that people understand inflation much better, obviously, because they see that basically what they have to pay every day only goes up, and what they earn every day only goes down in purchasing power. Why is the narrative of rate cuts so dangerous? First, because it is insane looking at the history of money to think that you are going to solve a problem created by the largest and quickest money increase in history, which was between March 2020 and September 2020, that you're going to solve the problem created by that in a year. That makes absolutely no sense. And obviously, because anyone that understands the CPI index understands that the base effect has been the largest component of the so-called reduction. And I always say to my students, if I gain 10 pounds a year, and then in the next year I gain 4 pounds, I'm not getting any thinner. That's the way to understand inflation. No, the prices of goods and services that are in the basket of what we call the non-replaceable goods, those things that you need to pay for every day, no matter what. It's not a choice. Hotels are a choice. Technology is a choice. And let me just say one thing to people that are looking at it, watching it. Inflation doesn't go up because of oil or because of the supply chains or because of a war. One price may rise because of an exogenous factor, and it may rise throughout a period of time. But if the quantity of money is the same and the velocity of money is the same, that price increase would make the rest of prices decline, not go up. A war doesn't make prices go up, makes most prices go down because the units of currency that you need to pay for oil are taken away from the units of currency that you have to pay for the rest of goods and services. Furthermore, commodities, supply chain disruptions, etc., may affect CPI in a short period of time, but they don't generate what inflation is, which is an annualized, consolidated, and then increased again level of price. And the only thing that makes aggregate prices go up in unison all the time, consolidate the increase generated by an exogenous factor, and continue to rise is the issuance of more units of currency than those that are demanded by the productive economy. That is as simple and as complicated as that, is that inflation is not generated by supply chain disruptions or by greedflation, that's stupidity invented by statism, etc. So come back to the market. Inflation, real inflation, means the destruction of the purchasing power of the currency. Therefore, not being invested in that environment is not just unadvisable, it's insane, because basically the only way in which you can actually combat inflation is by investing in assets that offset that inflation factor. Rate cuts, it makes no sense for the market to bet on one thing and the opposite at the same time. The market is currently betting on there's going to be 5 to 6 rate cuts and the economy is going to be in a soft landing. That has never happened in history. No central bank has ever acted preemptively. If central banks cut rates 5 or 6 times in 2024, it will be because the data that they're seeing is a massive reduction in the aggregate demand of the private sector, because we have already established that the aggregate demand of the public sector is not coming down, okay? So what we're talking is about a huge recession that would drive a rate cut. Be my guest owning cyclical stocks in that scenario. And the Fed has never in history taken aggressive monetary actions on the amount of money and the cost of money in an election year on top of all of that, apart from no central bank in history being preemptive and therefore cutting rates before the economic data shows this monster recession that I was mentioning.